and welcome to this another episode of ECCB Connects. This week we're continuing our discussion with Alex Straun, financial technology developer, on the topic of e-money.
E-money refers to any digitization or virtualization of existing currency stored magnetically or on a central computer or device. One would be surprised that e-money is how pervasive e-money is today. For example, the very debit cards that you're using is accessing money stored centrally on your bank account, and that is fundamentally e-money.
We know for example, cash, that is controlled by commercial banks and on a bigger scale, central bank.
Right.
But with digital currency, who is in control here?
Here, and that's the legal impediment to digital currency, and that is why, as pervasive as it is, there is no single entity that controls most of these digital currencies.
So it's unregulated.
So it's not just unregulated. The amount of currency in circulation is based on algorithms and not necessarily based on a particular entity. So there's no one to hold to account. Typically with central banks, the money in circulation is supposed to back by foreign exchange, gold, fiat, etc. That's quote unquote what it should be. With digital currencies, there's no such thing. It's just based on trust.
Wow.
It's just fundamentally based on trust. And I think almost like supply and demand. So who technically has the currency, that's an asset to them, and they could do whatever they want with that asset. But digital currencies more resemble an asset that you so happen to get a hold of, rather than a currency that you could go back to an entity and say, you're responsible for this. Now they're hybrids, meaning that recognizing the fundamentals of the technology that supports digital currency, what has happened is that persons have been trying to create what we call private blockchain networks that, while it uses the blockchain infrastructure, the currency that is the value that these are denoted in would be the currency of the country, the sovereign, and that makes it more in line with normal e-money. Bitcoin is not one of those, unfortunately, at least not yet, but the technology can be used to create e-money in the legal sense of it.
How prevalent is digital currency in our region?
Not prevalent in our region. We know in Jamaica and Barbados there have been what they call Bitcoin exchanges based on Bitcoin, but it's not being prevalent. And again, it comes back to something that we spoke of earlier, that if the solutions that are being developed and implemented are not packaged and put in a way that they can be broadly adopted by everyone in terms of access and circulation, then it makes it even more difficult. Blockchain has had its, not blockchain, but Bitcoin has had some bad press. So you have to get past that hurdle. Then you have to make it accessible. And sometimes in explaining to people the complexities of how do you get access to Bitcoin, etc., then it becomes an issue. So I think before we could get into digital currency, persons must transcend, go through or transition through generally e-money before they could deal with currencies that they are not accustomed to. And I think it's that sort of progressive tiered response and growth that would benefit us.
Cash, we know, is widely used in our region, but now we're being encouraged to go, the way of the advancement of the world to e-money and so on. But I know with cash, you have certain types of risk associated with using cash. What are the risks associated with e-money?
The major risk associated with e-money would be, as I would think, is the infrastructure. That reliance on that infrastructure, if anything happens to the infrastructure. The secondary risk to that would be how safe. Before, with physical cash, persons needed access to you to be able to access that cash. So it could only be taken from you with some physical interaction. Now, with e-money, depending on the technology, etc., if sufficient safeguards are not put in place, persons could remotely, they don't need physical, just like how you could do frictionless payments, then persons could access your bank account without being in the country, going into the bank. So these are some of the fundamental risks. It's really a security risk. One must understand, though, that typically persons gain access to that sort of infrastructure because of the user themselves. Just like with carrying around physical cash, one could be careless. One could be irresponsible in displaying specific sort of behavior in terms of just counting a lot of cash in public, making yourself a target, leaving your house unlocked, not being diligent in terms of your approach and how much cash you work with, etc. It's the same principle. People could be careless in terms of their password, the security arrangements for whatever is their e-money device. And those are the fundamental risks associated with it.
Okay. Alex, I know out there there's the call for moving away from cash, moving towards this whole e-money, e-payments. And to me, most of our people, like you said, 80% of our transactions, they're still being conducted in cash, and most of our people still using cash. It might sound intimidating. This e-money concept might sound intimidating for some of our people, especially some of our older people who are not so much, into computers and so on.
This is where innovation comes in, and this is where common sense must always go hand in hand with innovation and technological development. So take, for example, the fundamentals of cash is that for me to pay you, all I need is the ability to count or to recognize value, and I can easily just transfer this to you. There are no complicated issues. Same thing if I'm writing your check, I just need to know who you are, etc. No special infrastructure. Whether you are a business, if you need to give me a refund, you just basically either write me a check or give me cash. Any e-money innovations have to adopt similar approaches in that how easy it is for me to transact with you. So let's take the old lady or the elderly lady. She needs to catch a bus. She might have, what does she have? She might have a phone, but she may not be too familiar with the phone. An e-money app should be such that by virtue of she tapping on it, she can interact easily with the bus driver, whether she touch the phone and by default it recognizes what is happening, who is it, etc., and how much to take. Or it can be one where she just simply swipe a card and the transaction is completed. Again, we need fail-safes inside with these sort of systems, that the persons who is going to facilitate or interacting with this elderly lady, one, are either responsible and upright persons so that they don't abuse the vulnerabilities, and or the systems in itself, without being overly complicated, have sufficient safeguards to protect her transmitting the value that she needs. But this is where common sense comes in. And if e-money is to be widely adopted, then it must cater to not just only the computer literate persons, not only the businesses. It must be catered to all aspects of society. If that doesn't happen, then we are creating a two-tiered society, and that two-tiered society would cater to almost like an underground market, in some cases, nefarious activities. So common sense must always prevail, and solutions must always be inclusive. Too many times you hear solutions being developed, but they're targeting the brilliant people, the people who are totally comfortable, and the other person left out, and those are the ones who tend to be vulnerable to robberies, to crimes, etc. So we need to develop solutions that are inclusive of the vulnerable.
Alex, central banks, like the ECCB, they are responsible for the issue and management of currency, that's hard cash. So now with e-money, where does that leave central banks?
Well, and that's a good question. And my thoughts on the matter is that central banks need to be at the table. The central bank should never, ever not be at the table with any discussion on e-money. For the very reason that they are issuing the currencies, yes, but currency issuance and management have implicit costs. Costs for printing, minting, and circulation, security, taking money out of circulation, destruction of unfit notes, etc. Those are costs associated with management of currency. Now, if you are digitizing some of the currencies that you typically would have put into circulation, then that reduces the inherent cost for the central bank in terms of the management of the currency in circulation, since some of it is actually being digitized. Now, again, this is where we have a balance. Now, if central bank is at the table, central bank can establish what is the implication for it from a seigniorage perspective. So some central banks rely on the amount of currency in circulation in terms of how it deals with, well, how it manages its balance sheet, how it manages the economy, how it introduces liquidity or not. So there are solutions where a central bank can control the amount of e-money in circulation. But again, the central bank has to be at the table to decide how far, how participatory it will be, and what sort of scope it wants to apply in terms of the control of
So e-money doesn't make central banks irrelevant?
No. Irrelevance, I would say, is a function of the attitude of the central bank. A central bank could sit back and just watch e-money, bypass it, and then play catch-up. Or a central bank could be proactive and ensure that it is part of the discussion, part of the understanding, part of the research, part of the facilitation, and then from that perspective, it can then decide just how much it will participate. But if it's not at the table, if the central bank is not at the table, if the central bank is not part of the research, part of the discussion, then the central bank would always play catch-up and very well could be fighting its irrelevance.
Any final words as we wrap up?
This is a new frontier, and as we move forward, as we evolve as humans, etc., we recognize that with the technology as it changes and it's evolved, there are opportunities, there are strengths, there are weaknesses, and there are threats. It is for us to take the best of these new initiatives and ensure that our citizenry, our citizens, our businesses could make the best of it. What that would translate to, the ease of doing business, efficiency in operations, and a very informed general public. And so it is to ensure that the discussion is always ongoing, that institutions like the central bank, governments are encouraging, come, let's talk, let's dialogue, rather than say, don't do it. And too many times, that's the attitude we take. If you don't understand it, you can't do it. We need to adopt some sandboxes where we say, let's get into the sandbox, let's play, let's see what we can do with this, and we gradually roll them out. So in wrapping up, I would say I would encourage the policymakers, the central banks, other regulators, and interested stakeholders to come together, talk, rap, play together, and roll over something that is in the best interest of the ECCU.
Alex, thank you very much for speaking with us on ECCB Connects.
No problem. You're welcome.
You're watching ECCB Connects, protecting our currency, developing our region. And now for this week's financial tip.
Hi, I am Kevin Vidal, graduate of the ECCB Small Business Workshop. Arm yourself with a financial parachute by starting an emergency saving account, which is money you will touch only in an event of a job loss or crisis.
To view any episode of ECCB Connects, anytime, any place, at your convenience, check out our YouTube channel, ECCB Connects.
That's it for this week's episode of ECCB Connects. Join us again next week for another program.